I'm Rick Kaler, and thanks for joining me. On the last Wednesday in July, I got several phone calls from clients. On the last Friday in July, nobody called. Why the difference? Well, on Wednesday, the S&P dropped 1.52%, and the NASDAQ Composite dropped 1.74%. On Friday, the S&P gained 0.7%, and the NASDAQ gained 1%. Now, a lot happened in between those 2 days. The Federal Reserve held rates steady and gave no guidance about what comes next. Amazon reported earnings and gained 15%. Apple reported and lost 7%. Oil prices moved based on the war with Iran, and all these events earned headlines. None of them changed where the month ended. For the last week of July, the S&P 500 and the Dow each finished up about 1%. For the month, the S&P finished down 0.1%, and the Dow finished up 0.3%. A volatile month, this is the point, a volatile month ended almost exactly where it started. Now, how volatile your portfolio feels depends mostly on how often you look at it. Daily prices jump around like crazy. Weekly prices, they jump a little bit less. Monthly prices are smoother than weekly, and weekly smoother than daily. And annual prices are smoother than monthly. So checking more frequently doesn't change your investment return. It does change your level of anxiety. Okay, to understand this, think of the value of your house. Most people will believe home values rise steadily along with inflation. And they believe it's partly because nobody appraises a house every morning. If strangers knock on your door each day with firm cash offers, you would watch your home value fluctuate the way your 401k does. So the point is, frequent checking produces fear. Losing money feels considerably worse than gaining the same amount feels good. So every look at a falling balance registers as a small emergency in the brain. And the more emergencies you live with and through and experience, the more likely you are to act on one. I've seen clients sell because of a sudden drop and then spend 2 years waiting for a re-entry point that never felt safe enough. Since 1980, the S&P has fallen an average of 14.2% at some point during each calendar year. And this is according to some research I saw at JP Morgan's Guide to Markets. And yet, annual returns were still positive in 35 of those 46 years. Even the worst stretch on record is milder than most people assume. The weakest 10-year run for the S&P 500 in the modern era was 2000 through 2009. It included a 22% loss in 2002, 22%, and a 36.6% loss in 2008. Remember 2008? Yet the decade's annualized loss was less than 1%. Now, investors who held through the two worst years came out roughly even after 10 years. Those that sold in those two worst years, and I remember them, got nailed. The S&P then spent July going nowhere. Whether that month was calm or nerve-wracking, depending on how often you checked your portfolio. Well, yeah, it just depended how often you checked your portfolio. Over the years, I've received a lot of client calls about dramatic daily market drops. I haven't ever had a client call because of a flat month. So here's my suggestion. Look less often. Even if you have to start dialing it down gradually. Move from daily to weekly. When weekly stops bothering you, move to monthly. And then just read the monthly statements when you get them by email or in the mail instead of logging in at other times. To make it even easier, turn off price alerts on your phone. Take your brokerage apps off your home screen. This reduces the opportunities to react. Now, I wrote that several years ago, and this isn't new information. And I've said in the past, the only thing you can count on the stock market to do is fluctuate. You can count on it. And the wisest response is usually to do nothing. Nothing in the past few weeks has changed my mind. I still believe that. Looking less often will not change your return, but it will make you far less likely to damage the return you already have. Thanks for listening.